Hello, everyone. Welcome to Edgemoor Investment Advisors 2021 Market Review and Outlook for 2022. I'm Tim Coughlin, and I'm joined today by my colleague, Gay Truscott. We are pleased to be making this presentation for our clients and our friends. Our agenda for today will follow the quarterly report, which went out last week and is also posted on our website and blog. Gay will start with a review of 2021, an extraordinary year for equity investors, and in particular, our clients. She will then talk about interest rates and inflation, followed by Edgemoor's outlook for 2022. I will then provide a review of two stocks we are currently buying, Berkshire Hathaway and Jacobs Engineering. So let's get started with Gay.
Thank you, Tim. 2021 was an outstanding year for equity investors. The S&P 500 returned 28.7% for the year, which, when combined with the strong returns of 2020 and 2019, marked the S&P's best three-year run since the mid-1990s. You can see on this slide the S&P 500's steady climb since its pandemic low point in March of 2020. The reopening of the economy, combined with increasing consumer confidence, robust corporate earnings, and accommodative monetary and fiscal policies, all combined to drive the market to new heights. It was even able to largely shrug off two new variants of COVID-19, the Delta variant in midsummer and the Omicron variant in November and December.
By contrast, it was not such a good year for bond investors. The Barclays Aggregate Bond Index returned a negative 1.5% due to the adverse impact of rising interest rates on bond prices. It was the first negative return year for bonds since 2013.
Now, there are two main challenges facing the market: rising interest rates and rising inflation. Let's start with inflation. The powerful monetary and fiscal stimulus measures employed by the Federal Reserve and Congress during the pandemic helped avert a prolonged recession, but also helped push inflation to its highest level in decades. The Consumer Price Index, or CPI, regarded as the broadest measure of inflation, soared to an annualized rate of 7% in December, after rising to 6.8% in November, both exceeding expectations. The surge in prices for everything from energy to housing to food accelerated during the fourth quarter and now appears to be less transitory than first expected. And while many of the supply chain disruptions that led to higher prices last year are likely to dissipate, some inflationary pressures may be longer term. The Federal Reserve has sprung into action, signaling in its December meeting that it intends to accelerate the tapering of bond purchases and begin to hike interest rates this year. Specifically, the Fed expects to cut its monthly bond purchases by half in January and stop adding bonds altogether to its balance sheet by March, rather than later in 2022 as previously forecasted. Once its tapering is complete, the Fed expects to start raising the federal funds rate to further quell inflation, with 3 rate hikes indicated for this year. The 10-year Treasury rate has already begun to move higher in anticipation of these Fed actions, hitting 1.87% this month. Let us point out that a rise in rates does not necessarily signal the end of a bull market. This slide shows that average S&P 500 returns are typically solid 1 to 2 years after an initial rate hike, due to generally strong economic growth and corporate profits. Also, a shift in monetary policy often works with a 1-year lag, meaning any effects from interest rate increases this year may not be felt in the economy until next year. We do anticipate, however, that tighter monetary policy will lead to increased market volatility. Looking ahead, the U.S. economy should continue in its mid-cycle recovery, marked by moderate GDP growth, low unemployment, and solid corporate profits. As evidence of this, the December unemployment rate hit a pandemic low of 3.9%, down dramatically from the pandemic high point of 14.8%. Expectations for fourth quarter 2021 GDP growth are also strong at an annualized rate of 6%. Looking ahead, GDP growth is projected to be a solid 3.5% in 2022 and 2.9% in 2023. Finally, corporate profits continue to grow in the pandemic recovery and are projected to increase 8.7% in 2022. So Edgemoor's outlook. On balance, our outlook is generally positive due to the factors we've discussed, that the economic recovery and expansion are continuing, corporate earnings are continuing to grow, wage and job growth are at historic highs, and hopefully the pandemic should fade in 2022. But the challenges we've talked about, including rising interest rates and inflation, are on top of the slowing impact of Fed actions could have on economic growth. In addition, we expect to see continued market volatility and even a market correction this year. A market correction is a decline of 10 to 20% from a recent high. Typically, corrections occur about once every year or two. We have not had a correction since the COVID-induced bear market in the spring of 2020. So it seems likely that we will have a market correction this year. But we believe that the market will regain losses from a correction in a short to medium term time frame, which is typically what occurs. We also believe that over the long term, the equity markets are very good for U.S. investors. As a result, we do not anticipate any major changes to our investment strategy. We are actively pursuing new investment opportunities in areas we see as favorably positioned, like infrastructure and financial services. On the income side, we continue to favor dividend-paying securities like utilities, telecom stocks, and real estate investment trusts over fixed-rate bonds and treasuries. Overall, we believe in the durability of the broadly diversified portfolios we construct for our clients, and we expect them to perform well through a full market cycle. Now I will turn it back over to Tim to talk about two of our favorite stocks.
Thank you, Gay. The first stock I'm going to report about is Berkshire Hathaway, whose 2021 stock performance and investment statistics appear on the slide being shown. Run by Chairman and CEO Warren Buffett since 1965, Berkshire Hathaway operates on a decentralized basis, with the managers of each operating subsidiary empowered to make their own business decisions, leaving Buffett and his partner Charlie Munger to focus on investments and capital allocations. This highly successful formula has enabled Berkshire to generate stock returns in excess of the S&P 500 index over the company's 57-year history. Specifically, Berkshire's stock delivered an annualized return of 20.2% between 1965 and 2021, compared with 10.5% for the S&P 500 index over the same period. One of our largest and longest held stocks, Berkshire is a holding company with multiple subsidiaries in a variety of industries, the three most important of which are the insurance business, the railroad business, and the utility and energy business. The engine of much of Berkshire's success is the insurance business, which includes Geico and General Re. The insurance business generates significant cash from premiums called float, which insurers receive in advance of payouts of insurance claims. This low-cost capital has always been one of the most compelling advantages of Berkshire's business model, which it has invested together with its operating cash from non-insurance businesses over the years in corporate acquisitions and publicly traded securities. At September 30, 2021, Berkshire owned 42 publicly traded stocks worth $311 billion, of which the two largest were $125 billion of Apple and $45 billion of Bank of America. And in addition to its publicly held stocks, Berkshire had $145 billion of available cash for further investment in public equities and opportunistic corporate acquisitions. Another important business line for Berkshire is its railroad business, BNSF, which carried more than 15% of all non-local U.S. goods transported in 2020. BNSF is poised to continue to grow and generate solid returns on invested capital. A third primary business segment is Berkshire's utility and energy business, the Berkshire Hathaway Energy Company. Including affiliates, it has 4 public utilities, 5 pipeline companies, plus electrical transmission companies. Berkshire Hathaway Energy's emphasis is on renewable energy. In May of 2021, Buffett named Craig Abel, the long-standing CEO of Berkshire Hathaway Energy, as his successor. We believe Abel is eminently qualified for the role. Berkshire also has over 100 important manufacturing subsidiaries grouped into 3 categories: industry products, building products, and consumer products. Berkshire's stock outperformed the S&P 500 index in 2021, returning 29%, and we believe it will continue to be an excellent long-term investment. Mr. Buffett and his team are disciplined managers whom we believe will be able to successfully continue investing Berkshire's enormous cash position as they have done for so many decades. The second company I'm going to report about is Jacobs Engineering. Jacobs Engineering is a new investment for us, purchased in August of 2021. It is one of the largest engineering and construction firms worldwide, providing technical, professional, and construction services across a broad array of industries, and should continue to benefit from increased spending on a host of economic trends: digital modernization, cybersecurity, the rollout of 5G, the energy transition to renewables, water transportation rebuilds, and supply chain investments, among others. Jacobs' businesses have a particularly massive opportunity from the U.S. $1 trillion infrastructure legislation that was passed in November 2021. In fact, the company has noted that 95% of that bill's funding overlaps with its businesses. The company operates 3 lines of business: People and Places Solutions, 59% of revenues. Critical Mission Solutions, 36% of revenues. And a newly organized division in PA Consulting, 4%. Jacobs has considerable expertise in complicated, high-profile projects that are not easy to execute. They have built strong relationships in the United States and internationally with governments and corporations over decades that typically result in future add-on business. Over the past several years, the company has gone through a transformation, selling certain oil-related businesses and streamlining their remaining operations from 10 business lines down to 3. This has resulted in a more efficient cost structure, which they can now leverage to capture higher margins in their business opportunities. The company generated $14.1 billion in sales in fiscal year 2021, and it currently has a new business pipeline of greater than $30 billion over the next 18 months. The stock trades at approximately 18 times forward earnings, which is below the current S&P market multiple of 21 times. As a result, we believe the current share price is an attractive entry point for this high-quality, diverse company that will benefit from multiple secular growth trends and has a path to grow earnings at a mid-teens percentage rate. Gay and I are now finished with our reports. We appreciate your logging into our presentations. Gay, do you have any further words to say?
Yes, we hope you found this presentation informative. We always appreciate your feedback, and we look forward to seeing you again next quarter.